Imagine this. It's a crisp morning in Manhattan. A line forms outside a gleaming bank tower. Not for loans or deposits, for withdrawals. Panic spreads like wildfire. Phones buzz with rumors. By noon, the doors lock. Billions vanish in hours. This isn't fiction. It's the ghost of crises past, haunting us again in 2025. Why talk about this now? Banks are sitting on a powder keg. Private credit loans, those shadowy deals to high-risk borrowers, hit nearly $300 billion in U.S. bank exposure this year. Moody's warns risks are climbing, especially for smaller players chasing growth. Frauds exploding, amplified by AI and sanctions. Geopolitical tensions simmer. One wrong move and the system teeters. Your savings? Caught in the crossfire. Let's pull back the curtain. Banks aren't just vaults, they're engines. You deposit $1,000. Feels safe, right? Locked away. But here's the twist. The bank doesn't stash it all. In the US, since 2020, reserve requirements sit at 0%. Zero. They hold what they deem necessary, maybe 3 to 10% in cash or safe assets. The rest? Out the door as loans. Picture it like this. You hand over your cash. The teller smiles. Behind the scenes, that money fuels a car loan for your neighbor or a business expansion across town. Banks profit from the spread. Pay you 1% interest, charge borrowers 5%. Neat arithmetic, but it's built on trust. Your deposit creates new money. That's the magic, or the illusion. Step 1. Deposits flow in. Everyday folks like you park money for safekeeping. Banks promise liquidity. Grab your cash anytime. But they can't afford to let it idle. Idle money loses to inflation, so they lend. Step 2. Lending begins. Not conservatively, aggressively. Why? Competition. Big banks chase yields in private credit. Loans to companies Wall Street won't touch. Think leveraged buyouts, distressed firms. In 2025, PwC reports banks are future-proofing risk with AI. Sounds fancy, but it's a gamble. Loan out $900 from your $1,000 deposit. Borrower pays back with interest. Bank wins. Borrower defaults. Trouble brews. Here's where it gets uncomfortable. The math. It's called fractional reserve banking. Roots traced to goldsmiths in old Europe. They'd store gold, issue notes. Realized not everyone redeemed at once, so they lent extras. Modern version, your $1,000 deposit. Bank keeps $100, lends $910 to Alice. Alice buys from Bob. Bob deposits $900. Bank keeps $90, lends $810. Chain reaction. That original $1,000 balloons to nearly $10,000 in the economy, the money multiplier. Elegant, terrifying. But wait, what if everyone wants their money back? Bank runs, like Silicon Valley Bank in 2023. Tech deposits surged, bank parked in long-term bonds. Rates rose, bonds tanked, depositors fled. $40 billion gone in a day. Government bailed, taxpayers footed. Irony, banks preach caution to you, yet they bet big with your funds. Contrast the hype. Ads show sturdy buildings, smiling families, your money's secure. Reality, risks stack up. Credit risk, borrowers flake. Interest rate risk, rates spike, loans sour. Liquidity risk, can't sell assets fast. In 2025, commercial real estate's a minefield. Empty offices from remote work. GAO reports small banks overloaded on these loans. Aggressive growth, weak oversight. Echoes of 2008 subprime. Back then, banks bundled junk mortgages, sold as gold. Bubble burst, trillions lost, millions homeless. Quiet humor in the absurdity. Banks limit your overdraft to $50, but they'll lend billions to shaky ventures. Because? Profit. Shareholders demand returns. Regulators? They tweak capital rules post-crisis, force banks to hold buffers. Yet exposures grow. Federal Reserve's 2025 analysis eyes non-bank lenders, private equity sucking in bank cash, indirect risks, hidden chains. Escalating now. Zoom out. One bad loan, manageable. Systemic, catastrophe. 2008 taught us, banks interconnected. One falls, dominoes tumble. Today, add cyber threats. RMA survey 63% of chief risk officers flag it top tier. Hackers drain accounts, or geopolitics. Wars disrupt payments. Canadian banks in 2025 cite cybersecurity and uncertainty as nightmares. McKinsey warns, banks must pivot or perish. Bigger picture. This risk fuels growth. Loans build homes, start companies, drive GDP. U.S. economy hums at 2 to 3% annually partly because of it. But the downside? Inequality widens. Big players get bailouts, small fry suffer. And climate? Banks fund fossil fuels with excess deposits, over $700 billion in 2023 alone. Your savings powering the problem. So we circle back. Banks take big risks because the system demands it. Profit over prudence, growth over stability. But at what cost? Next crisis looms. Will it be private credit cracking, real estate imploding, or something unseen? One question lingers. In a world where banks gamble with your future, who's really holding the cards?